Welcome to our video exploring the fascinating concept of the money multiplier. Today, we'll dive into how the money supply can grow exponentially through a simple process of lending and redepositing. But first, let's address a fundamental question. What is the money multiplier? In economics, the money multiplier refers to the maximum potential amount of money that banks can create from an initial deposit. It's crucial for understanding how money flows in an economy. This concept is not just theoretical. Its implications ripple through various economic activities and banking operations. By comprehending the money multiplier, we can appreciate its significant role in economic growth and financial stability. As we begin this journey, we'll demystify this complex idea, making it accessible and relatable. Get ready to see how something as simple as depositing and lending money can have profound effects on the overall economy. In our next segment, we will delve into the problem of limited initial deposits and how this creates constraints on the money supply. So stay tuned as we unravel the intricate details of the money multiplier and its wider impact. In the intricate dance of our economy, banks hold a pivotal role. Let's start with a fundamental challenge they face: limited initial deposits. When banks open their doors, they begin with a finite amount of money from initial depositors. This limited money supply acts as a restriction, bottling up the potential for lending and economic activities. It's like a small pool. The smaller it is, the fewer resources banks have to lend out, stunting economic growth from the start. This is where the money multiplier theory comes into play, offering hope in an otherwise constrained system. As we unpack this theory, you'll see how a simple concept can radically alter the entire financial landscape. Why is this initial limitation so critical, and how can the money multiplier turn the tide? Stick with us as we delve deeper into the mechanics behind this transformative idea. Banks play a crucial role in our economy. They are not merely vaults for storing money, they drive economic activity by lending and accepting redeposits. When you deposit money into a bank, it doesn't just sit there. Instead, the bank lends a portion of it out to others. These borrowers spend the money on various goods and services, which eventually finds its way back into the banking system as new deposits. This continuous lending and redepositing process generates the money multiplier. The initial deposit becomes part of a cycle that sees money supply growth far beyond the original amount deposited. This process is fundamental to understanding how banks influence economic growth and financial stability. As we explore further, we'll see how the money multiplier works in more detail and why it's a cornerstone of modern economics. Next, let's dive into how the lending process works and why it's so crucial. When banks lend money, they charge interest, a fee paid by borrowers for using the loan. This interest rate is a critical component of the lending process and a key revenue source for banks. But why is lending so vital? It powers economic growth by allowing individuals and businesses to finance purchases and investments they couldn't otherwise afford. Banks, in turn, use the interest earned to lend more money, creating a cycle of economic activity. Lending also sparks the money multiplier effect, where each loan and redeposit amplifies the overall money supply. So every time a bank extends credit, it's not just facilitating a single transaction, but contributing to a larger economic engine. The intricate dance of lending and borrowing underpins the entire financial system, making it indispensable. As we move forward, you'll see how redepositing plays an equally crucial role in this dynamic process. Now that we understand the lending process, let's dive into the concept of redepositing and how it plays a crucial role in the money multiplier effect. After receiving loans, individuals and businesses don't hoard the money. They redeposit it back into the banks, creating a continuous cycle of deposits and loans. For example, when a business takes out a loan, it might use the funds to purchase supplies, hire employees, or expand operations. These activities generate more transactions, resulting in more money being deposited back into the banking system. The redepositing process is fundamental because every time money is redeposited, it becomes available for the bank to lend out again. This cycle amplifies the initial deposit, increasing the overall money supply. Understanding redepositing allows us to grasp how banks can multiply the amount of money circulating in the economy. Next, we'll look at the formula to calculate the money multiplier and see it in action. So, stay tuned as we break down the math behind this fascinating concept. The money multiplier is a fascinating concept in economics, and calculating it is quite straightforward. It all comes down to a simple formula: 1 divided by the reserve ratio. This ratio determines how much of deposited money banks are required to keep in reserve. For instance, if the reserve ratio is 10%, the formula becomes 1 divided by zero point 0.1, giving us a money multiplier of 10. In essence, each dollar deposited can potentially generate $10 through the banking system. Let's consider an example to illustrate this. Imagine a bank receives a deposit of $1,000. With a reserve ratio of 10%, the bank must keep $100 in reserve, but can lend out $900. The borrower then potentially redeposits this loan, and the cycle continues. Each round of lending and redepositing grows the money supply incrementally until the initial $1,000 deposit has spurred up to $10,000 in new money. As we move forward, you'll see how these theoretical calculations play out in real-world scenarios, providing a deeper understanding of the money multiplier's impact on our economy. Stay with us as we bring these concepts to life with practical examples. Let's look at a real-world example to see how the money multiplier works in practice and its impact on the economy. Imagine a scenario where a bank receives an initial deposit of $1 million. With a reserve ratio of 10%, the bank is required to hold $100,000 in reserve, but can lend out the remaining $900,000. The borrowers then use this $900,000 to fund various activities, perhaps buying supplies, hiring employees, or investing in new projects. As these funds circulate through the economy, they are redeposited into banks, which then lend out a portion of these deposits based on the same reserve requirements. This process continues, multiplying the initial deposit many times over. The outcome is a significant increase in the overall money supply, fueling economic growth and boosting financial activities. The real-world impact of this money multiplication is profound, affecting everything from consumer spending to business investment to government infrastructure projects. As we move forward, you'll see the greater impact this has on the broader economy and the critical role it plays in driving growth and stability. The money multiplier holds a critical role in the broader economy by increasing the money supply, which in turn fuels economic growth. Through a cycle of lending and redepositing, the money multiplier significantly boosts the financial capacity of banks, enabling them to lend more and encourage investments. Imagine this. Each dollar deposited in a bank can potentially turn into multiple dollars in the economy. This expanded money supply leads to enhanced productivity and more robust financial markets. However, the real significance lies in its impact on economic growth. With more money circulating, businesses can expand, infrastructure projects can be financed, and innovation can thrive. As we delve deeper, observe how this financial mechanism reshapes economies by reinforcing the banking system's ability to support growth. We'll next explore how these processes face real-world challenges and limitations, offering a balanced view of this influential concept. While the money multiplier is a powerful economic concept that explains how the money supply can grow through lending and redepositing, it is not without its limitations and challenges. One significant limitation revolves around the reserve ratio, the fraction of deposits that banks are required to keep on hand. This reserve ratio can limit the potential for money creation because it restricts how much can be lent out. Moreover, economic conditions play a crucial role. During times of economic uncertainty or downturns, banks may become more cautious with lending, further affecting the money multiplier effect. Additionally, factors like regulatory changes, technological advancements in banking, and changes in consumer behavior can introduce complexities that impact the overall efficiency of the money multiplier process. It's essential to recognize these potential challenges to fully understand both the power and the limitations of the money multiplier. As we move forward, we'll recap the key points to solidify your understanding of this fundamental economic principle. As we come to the end of our journey through the money multiplier theory, let's recap the key points we've covered. We've seen how initial deposits in banks form the foundation of the money supply. We explored the lending and redepositing processes that banks use to multiply money. Through our explanations and examples, we understood the formula for calculating the money multiplier and its significant impact on the economy. We also discussed the challenges and limitations that come with this concept. In summary, the money multiplier is a crucial concept in economics, demonstrating how the money supply increases through repeated lending and redepositing. By understanding this, we gain insight into the pivotal role of banks in economic growth. Thank you for joining us, and stay tuned for more insightful content. If you found this video helpful, please like, share, and subscribe for more educational content on economics. Your engagement helps us continue to create high-quality, informative videos. Dive deeper into the fascinating world of economics by exploring our other videos on similar topics. Share this with friends and peers who might benefit, and let's keep the conversation going. Stay tuned for more insights into how our financial system works and impacts our daily lives. Thank you for watching.